Imagine applying for your dream car, a mortgage, or a low-interest credit card, only to get hit with an instant application rejected message because of a credit score you didn't even realize was low. Or worse, watching thousands of your hard-earned dollars get wasted on sky-high interest rates every single year. The truth is, the American credit system can feel like a rigged game where the rules are kept secret. Millions of people follow financial advice that sounds completely logical, only to find out it is actively destroying their credit score and trapping them in debt. In this video, we are debunking the top 5 credit score myths that are costing you money and showing you how to reach an 800+ score.
Before we tear down these damaging myths, you must first understand the underlying machinery of the credit system. In the United States, over 90% of top lenders use the FICO score system, created by the Fair Isaac Corporation. Your FICO score ranges from 300 to 850, and it is calculated using a very specific formula split into 5 distinct categories. First, at 35% of your total score is your payment history. This is the single biggest chunk of your score, measuring whether you pay your bills on time every single month. Second, accounting for 30% of your score is your credit utilization, the percentage of your total available credit limit that you are currently using. Third, at 15% is the length of credit history, which calculates the average age of all your accounts combined. Fourth, at 10% is new credit, which looks at how many new accounts or hard inquiries you have recently added. And finally, the remaining 10% is your credit mix, which evaluates whether you can responsibly manage different types of credit, like credit cards, auto loans, and mortgages. Understanding these 5 pillars is your secret weapon. When you know how the system is calculated, you immediately realize why so many popular finance tips are complete lies.
Let's dive into myth number 1, the single most expensive mistake made by millions of cardholders. You need to carry a small balance on your credit card every month to prove you use it and build credit. If you have ever been told to leave $10 or $20 on your credit card at the end of the month instead of paying it down to zero, you have been lied to. Credit card companies love this myth because it makes them billions of dollars in interest every single year. The truth is crystal clear. Credit bureaus do not track whether you are paying interest. They do not give you bonus points for carrying a balance from month to month. The credit bureaus only receive 2 key pieces of information from your credit card issuer at the end of your billing cycle. First, did you make your required payment on time? And second, what was the total balance printed on your official statement? When you carry a balance, all you are doing is triggering steep interest charges, often at 25 to 30% annual interest rates. The golden rule to master this system is simple. Always pay your statement balance in full before the due date. You get 100% of the credit building benefits. Your payment history is logged as flawless, and you pay exactly $0 in interest.
Myth number 2. Checking your own credit score causes it to drop. This widespread fear keeps millions of people completely in the dark about their financial health, afraid to even log into a banking app to look at their numbers. To understand why this is false, you must know the difference between a soft inquiry and a hard inquiry. A hard inquiry happens when you formally apply for new credit, like a mortgage, an auto loan, or a new credit card, and you give a lender permission to pull your full report. A hard inquiry can temporarily dip your score by 3 to 5 points. However, when you check your own score using your bank's mobile app, free monitoring services, or official annual credit report sites, it is classified as a soft inquiry. Soft inquiries have absolutely zero impact on your credit score. You could check your score 10 times a day, every single day of the year, and your score would not drop by a single point. In fact, failing to check your credit report regularly makes you vulnerable to identity theft, fraudulent accounts, and credit bureau errors that can stay on your profile for years unnoticed. Regular monitoring is not a risk. It is your best defense.
Myth number 3. Closing down credit cards you no longer use cleans up your credit profile and protects your score. This feels intuitive. If you aren't using a card, why keep it open? But closing an old card can severely damage your credit in 2 direct ways.
First, remember that 15% of your FICO score relies on the length of credit history. Keeping your oldest accounts open maintains a long, established relationship with credit bureaus. Second, closing a card instantly destroys that card's credit limit. Imagine you have two cards with a $5,000 limit each, giving you a total limit of $10,000. Spending $1,000 keeps your utilization at 10%. If you close one card, your limit drops to $5,000. Now that same spend jumps your utilization to 20% overnight without spending an extra cent. Unless a card has an expensive annual fee that outweighs its value, never close your oldest accounts. Instead, put a tiny recurring charge on the old card, like a small monthly subscription, and set up automatic payments to keep the account active and your credit history growing.
Myth number 4. Earning a high salary or having a lot of money in the bank automatically gives you a high credit score. It is easy to assume that someone earning $200,000 a year automatically has better credit than someone earning $40,000. But credit bureaus do not care how much money you make. In fact, your income is not printed anywhere on your credit report. Your credit score measures debt management and reliability, not income or net worth. A high earner who misses payment deadlines or maxes out credit cards can easily have a terrible 520 credit score. Conversely, someone making a modest income who pays every bill on time and maintains low balances can easily achieve a perfect 800-plus credit score. Lenders look at your credit score to evaluate your character and reliability as a borrower, while they evaluate your income separately through pay stubs and tax returns when you apply for a loan. Never assume that a pay raise will automatically fix bad financial habits. Building elite credit requires disciplined systems, regardless of your income level.
Myth number 5. Using a debit card is a safer, smarter way to build credit without taking on debt. While using a debit card is great for preventing overspending, it does absolutely nothing to help you build a credit history. Debit cards draw funds directly from your personal checking account. Because no money is being borrowed, debit card transactions are never reported to the major credit bureaus, Equifax, Experian, or TransUnion. You could spend thousands of dollars a month on a debit card for 20 years, and your credit file would remain completely empty. Furthermore, debit cards offer significantly weaker fraud protection compared to credit cards. If a fraudster steals your debit card number, your actual bank account balance is drained immediately, leaving you fighting with the bank to get your rent money back. If your credit card is compromised, the credit card company's money is stolen, not yours, and you are protected by federal zero liability policies. To build credit safely and protect your money, credit cards are always the superior tool when used responsibly. Treat your credit card like a debit card. Only spend money you already have in your bank account and pay it off immediately.
Now that we have completely debunked the 5 biggest credit myths, let's pull everything together into a simple, actionable blueprint to get your score above 800. Step 1. Automate your payments. Set up automatic minimum payments on every single credit card so you never miss a due date. Since payment history makes up 35% of your total score, this single step protects the largest part of your credit profile automatically. Step 2. Master the 10% utilization rule. Keep your reported statement balances below 10% of your total credit limit across all cards. If you need to make a large purchase, pay off the balance a few days before your official statement closing date so the credit bureaus report a low balance. Step 3. Request credit limit increases annually. As your income grows and you build a solid history, ask your card issuers for higher limits. This instantly expands your credit pool, lowering your overall utilization ratio without requiring you to spend less. And step 4, diversify your credit mix naturally over time by adding different loan types when it makes financial sense for your life. Follow this 4-step blueprint consistently, and watching your score cross 800 is only a matter of time.
Building an elite credit score in the United States isn't about playing confusing games, paying expensive interest fees, or earning a massive fortune.
It is simply about understanding the rules of the system and setting up simple, disciplined financial habits that run automatically in the background. When you master your credit score, you unlock lower interest rates, lower monthly mortgage payments, and better loan terms across the board. That means thousands of dollars in lifetime savings that stay directly in your pocket where they belong. If this video helped clear up the confusion and gave you a clear roadmap to take control of your financial future, please hit that like button to help us share this knowledge with more people. Don't forget to subscribe to WealthMind USA and turn on notifications so you never miss our weekly breakdowns of smart, actionable wealth strategies. Our goal is to help you navigate the financial system with complete confidence and reach your true wealth potential. Drop a comment below with your current credit goals or any questions you have. I read and answer every single one. Let us know which credit myth surprised you the most or what topic you want us to cover next. Thank you for watching, and I'll see you in the next video.